In this recording, we're going to be looking at some strategic areas of tax and tax planning. We're going to kick it off with looking at superannuation. Now, from the outset, it has to be said that superannuation, in terms of how it fits in Australia and in our tax system, is something that changes a lot. And so it's very, very difficult in a recording such as this for us to be able to explain to you all of the important aspects of superannuation with a great amount of detail. And the reason for that is that it changes. Historically, super is something that governments will modify to some extent, sometimes every few years, sometimes every single budget. And so it's important when learning and studying tax law and revenue law at an undergraduate level to really appreciate that, look, in these subjects we're only going to be able to explain it to teach you guys the underlying principles of the superannuation system that we have. Everything is subject to change. And so the example that we have here, where we have an employee with a high amount of salary, so a person who's earning above the $180,000 salary point, whereby one is on the top marginal tax rate. Now, at the time of recording, the amount of employer superannuation contributions is 9.5%. So in this situation where we have an employee who's earning $180,000, you have $180,000 salary with 17,100 superannuation contribution, being 9.5%. We're also going to assume in this situation that this particular taxpayer has private hospital cover, so is not it doesn't have to And so really the question here is an employee who's earning beyond the $180,000 point where the marginal tax rate is at its maximum, should that employee, instead of taking an additional salary increase, elect to sacrifice some of that and put it towards superannuation? Now, when trying to determine whether or not salary sacrifice is an appropriate option or strategy a particular taxpayer should take, we really should just sit down and try and work out, well, what's their current tax payable anyway? And so here, we're just doing some, I guess, pretty straightforward calculations to work out what this particular taxpayer's amount assessable is going to be if they just took the money, if they already had an income above this $180,000 threshold and they just wanted to take it as straight salary. So to do that, we have to go to the Income Tax Rates Act. That's the place where the actual rates for a particular tax year are stored. And because Australia has a progressive tax system, the amount that you pay percentage-wise increases when you hit certain threshold income amounts for any particular year. So for example, assuming you're fully resident for 12 months, you pay no tax in the first $18,200 you pay, and then it's 19 cents for every dollar beyond that up to 37,000, 32.5 cents to the dollar for everything from 37 from 87. Between 87 and 180 you pay 37 cents, and then everything beyond that, the marginal rate is going to be 45 cents to the dollar. Also, we have this thing called the Medicare levy, which is essentially an additional 2% on tax paying. So in this situation, if our taxpayer has a salary above this $180,000 and they take in an additional $10,000, we just calculate what the tax is on the difference between those. And so the base amount at 180 is $54,232, and we just find the gap, so the extra $10,000 at 47 cents, and then we take the Medicare levy into account, which is just a flat 2% across the entire amount. So the net result, the tax liability is going to be $62,732. And so I guess this net position is this idea, well, if we add up all the income a taxpayer had for the year, and then we added that the amount of employer salary contribution, then we try and determine what this particular taxpayer's net position, or rather the increase in their net position, is at the end of the tax year. So here, the amount that's paid to the super fund, which would be $18,050, is contributed, but when a taxpayer contributes to a super fund, there is a 15% tax at that point. And clearly that's preferable to the top marginal rate, but just also note that when that particular super fund has investments and makes returns, that those returns are also taxed at 15% as well in any given tax year. And so the net position is really how much better this taxpayer is at the end of the year, which is $142,610. And of course, when advising clients on this, it's really important to note that while the taxpayer's net position is better, a fraction of that, a component of that, is tied up in superannuation. So you don't have access to that until you reach the preservation age and you actually go through the retirement process. So the next thing to look at is, well, what would happen if instead of taking this money we decide to sacrifice, do some sort of salary sacrifice? And the important thing to note here is this amount in the system at the moment called the concessional contribution cap. Essentially that's the point whereby you can deduct, you can make a salary sacrifice from your existing income and essentially have that as a tax deduction. It's just reduced from your income. And this is quite tightly controlled by the government, and you can kind of see why, because it's a very, very flexible way for a taxpayer to really change their net position at the end of the year. Now admittedly, again, some fraction of that will subsequently be tied up in super, but it's a really key part of our system to note that up to, at the moment, $30,000 can be taken from your income and deducted and put into super schemes without having an additional levy that's placed on those. And so in this problem, we, I guess as a strategic measure, would go and ask the employer to see whether or not this employee's salary can be sacrificed in order to really make full use of this $30,000 concessional cap. So here the difference between what her employer is already putting in of $18,050, the additional amount to sacrifice is going to be $11,950. And so note here that this salary sacrifice actually pushes the employee back down below the $180,000 threshold, and so we calculate the amount of income tax liability based on this new amount, $178,050. And so the amount of money in the taxpayer's hand at the end, their after-tax disposable income, is going to be $120,664. But you've contributed, this taxpayer's contributed a lot more towards the superannuation. And so that $30,000, 15% of it is taken away at the point of contribution, which is $4,500. But essentially that super balance is going to increase by $25,500 there. And when we add those two figures together, it comes out as noticeably more than if this taxpayer had just taken that extra 10 grand as salary. And finally, it's important to note with any of these superannuation problems that come up, and it would certainly be helpful to explain this in an examination situation or a class test, that the person, while their net position is better off, they're not going to be able to access that additional funds, the amount of money that's been put into the super scheme, until they reach the preservation age and go through the retirement process. the next thing we'll look at is employee termination payments. Now these are situations where a person's worked for an organisation for a long time and has received a large sum of money at the point of either retirement or redundancy. And again, if we just think about the underlying political and social difficulties here, if a person has worked for a place for a very long time and they're about to receive usually quite a large sum of money, it has to be taken into account that a person might not work again for a decent length of time, if at all. And so that there are some concessional tax rules around these ETPs, and it's important really to just know these. And so here we have a redundancy payment for an employee who has worked at one organisation for almost 17 years and is getting a decent sum of money, $100,000. So we have to, for this question, determine how we're going to tax that. Now, the first thing to note is that the ETP rules apply for what are known as bona fide or genuine redundancy payments, as that usually are as the result of either a dismissal or a person being made redundant. And the idea is that a certain amount of money is going to be exempt income. And the way we work that out is based on the formula, which is in section 85-170, that is simply that the amount that's going to be exempt is going to be a certain base amount, which is an index value, plus another index value multiplied by the number of full years of service. It's a pretty straightforward calculation. You just need to know here that it's only the amount of fully completed years. So in this particular scenario, a person terminated in June, but they started in July, way back in the year 2000. It's only 16 full completed years of service. And so here, if we take, say, the 2017 tax year, $9,936 is the base amount, and the amount of service for this particular taxpayer is only going to be 16 years because they started in July, finished in June, and so that's multiplied by what they call the service amount of $4,969. So the net result we get here is $89,440, and this is just simply exempt. Now you need to note though that the amount above this, so the additional $10,560 for the remaining, still gets some form of concessional tax treatment. And this treatment actually is dependent on the taxpayer's age. And so where you have a person closer to retirement, so over their preservation age, then it's 15% tax, whereas up to a maximum of $195,000. And if you're below that, it's 30%. Anything beyond $195,000 is taxed at the top marginal rate, 47 cents to the dollar plus a Medicare levy. Now, it's helpful when thinking about tax policy, superannuation, and strategy to really start thinking about what are known as self-managed super funds. These are funds, essentially trusts, established by people, by taxpayers or groups of taxpayers, that basically put the power in terms of managing the investments back in the hands of the trustees of that particular trust. As you can imagine, though, the ATO and the federal government is quite keen to keep a really close eye on these types of funds. But there is, as stated in the question, this technique of being able to put business premises, so commercial property, into one of these self-managed super funds and then lease it back to a company or a business that a particular taxpayer is deriving income from. And so here we're going to be looking at the advantages and disadvantages of doing that. And so the first few things to note here are the benefits, and there are a couple of these. I mean, essentially, the company that's leasing the property, they get a 30% tax deduction for a commercial lease. But the super fund itself that's doing the lease is only taxed at 15% on the income that comes in. and they still get a discount, a partial discount, a 33% discount on capital gain for this commercial property when they go to sell it. There are, however, as you can imagine, some pretty strong limitations on this, and really these flow from the fact that the federal government doesn't want people to blow their super, to invest it in very poor investments, or just spend it all on consumables and leisure assets. People want this thing to be taken quite seriously in order for people to create an asset base to be able to provide for their retirement. So they're not going to be a burden on the taxpayer at some stage later, when they've all run out of money and need to go on some form of age pension. And so the first thing to note here is that that in order to run a self-managed super fund in this way, it has to be a complying fund. In other words, you have to get a seal of approval or a tick off from the regulator that this particular trust is being run in a proper and prudential way. And that kind of makes sense, because fundamentally trusts are not really vessels for having business decisions and making commercial decisions that can't carry up to a moderate amount of risk. Really, trusts are designed to be very prudential vessels for preserving assets and the income that flows from those assets. Another limitation here is that you have to have fewer than 5 members, and all of those members have to be trustees of the particular fund. You can only purchase, and this is important, business land and buildings. You can't do this with residential property. Now, some other problems come from this, that, well, when doing this, trusts and unit trusts also, and this is tied up with the prudential rules as well, they can't borrow large sums of money to do this. And so you can have some difficulties here in terms of raising enough cash for the super fund in order to go and purchase this sort of commercial property in order to come into this particular arrangement. Another one, and this can be a real sticking point, is that the self-managed super fund can't actually acquire assets. It's not allowed to purchase those from related parties. In other words, members, trustees, or associates of members and trustees. Some exceptions to that are, look, if it's done at market value, and you can prove that. The sole purpose test is really this idea that real property that's purchased to be held inside a self-managed super fund must be intended to be preserved for the benefit of the people when they retire. It can't have other benefits. So, for example, with residential property, although not forming part of this problem, a self-managed super fund can't buy a rental property and then rent it out to the children or to other associates of the members and or the trustees. And so here with commercial property, the sole purpose of that has to be to have and hold this property for the purpose of deriving income, and really for preserving that asset to be able to give returns either through income streams or capital returns to the person at the time of their retirement. It can't be for other ulterior motives, such as to have and run a business and to do it at a discounted rate, or to run say a club or society to be able to use that asset really through the connection between the trustee or the member. And there's some other things to note. There are certain contribution caps. These change from year to year in terms of the amount of assets that can be moved into these funds. And CGT, capital gains tax, is going to apply. Now, complying super funds, they get a discount, but it's not as much as a natural person. They get the 33% discount as opposed to the 50%. And the last thing to note is, of course, that most states and territories levy stamp duty when real property is conveyed from one entity to another. Now, some other things to note, and again, this really flows from fundamentally from trust law, which you may or may not be familiar with. It's this idea that trustees have to be very careful. They can't take normal commercial and make regular business decisions as, say, a company director may do. They have to take a very careful, sort of measured attitude to making these investments. And largely that's because trustees that do and make outrageous decisions in terms of investing and really expending money in order to make risky decisions can be held liable for things. And the next thing to note is the in-house asset rule, and that is actually by default a self-managed super fund can't usually do these sorts of transactions and transfers to deal with assets that relate to members or trustees or associates of theirs. Those transfers and transactions are actually limited to 5% of the entire pool of assets of the fund. But there is an exception, and that's one of the reasons why this arrangement is popular. That the superannuation supervision legislation expressly states that business, so commercial land, real property, land and buildings, is actually an exception to this. The next thing to note is that the transfer has to be at market value. That's again quite straightforward, and there is this reporting requirement that the trustees are required when managing and running these sorts of SMSFs to actually have strategy. You've got to have a clear plan, and that has to be logical and take into account a host of things, including the variety of needs for the various members, liquidity of the fund, the need to diversify assets, and the underlying risk of each particular transaction. So here we're looking at some tax strategy, and particularly in relation to employees that are on the top marginal rate, and how fringe benefits, certain types of fringe benefits, can actually be beneficial to both employee and employer in these situations. And so here we're just going to start, part A is just looking at what would happen if you've got an employee who's already on a salary of exceeding 180 grand. What's going to happen if they get given a pay rise of $10,000 per annum? Then we're going to look at what's going to happen if some type of fringe benefit would be paid of that same amount to the employee, what the relative cost is going to be to the employee and to the employer, or rather the benefit to the employee and the cost to the employer. And finally we're going to look at what's going to happen if, rather than giving a bog standard fringe benefit, that the employer actually gives something that gets some form of FBT concession. And so here we're looking at in-house child care benefits. So the first situation is straightforward. What's the cost to the benefit to the employee is going to be the $10,000 less the amount of tax that employee is going to pay. So at the moment, with the 47 cents to the dollar with the Medicare levy plus the budget repair levy, is going to be $5,100 benefit to the employee. And so for the company's perspective though, assuming that the company tax rate is at 30%, the actual cost to the company is only going to be $7,000. So the second part is then looking at, well, okay, instead of giving you a salary, what if we give you some form of fringe benefit? So here, a reimbursement for home mortgage payments. There, the employee is going to get the full benefit. Oh, it's $10,000. Wonderful. However, from the company's perspective, they have to pay fringe benefit tax on that. So they're going to be going to accrue an additional $9,608 in FBT. Now, it's important to note here that this fringe benefit tax itself is an outlay, and so the company, although the total outlay here might be say $19,608, it does get a tax deduction. So the actual amount that it's going to really cost the company is going to be a bit less than that. But really, the actual cost there is going to be after you multiply $19,608, multiply that by 0.7 after removing the 30% company tax, is going to be $13,726. So the net result there is that, look, sure, the employee gets this great benefit of, oh wow, I get all of this money, this better for them to get that as salary, but the actual cost to the company is much, much, much more than it was just giving them a $10,000 pay increase. And so the next part of the question is that, well, what would happen if the company was prepared to pay fringe benefits equal to the amount that they would have paid for salary. So in that, the first part of the part A was saying that, look, when the cost of the company is $7,000, the benefit to the employee is $5,100. And the really important thing to note here is that it's exactly the same. In other words, giving a fringe benefit to an employee who's on the top marginal tax rate is not going to be any different from giving them salary. And that's really what this question's designed to get to think about. So while organisations can do this and give benefits to an employee, there's no real benefit to that. It would be just the same as giving the same employee cash. However, if the benefit is in the form of something where there is some type of exemption, so here, for example, giving the employee $10,000 in the form of an in-house childcare credit is really a win-win for both employee and employer. The $10,000 credit is not subject to FBT, so that the employee gets the full benefit of that $10,000 in terms of the credit, and the cost to the company still remains at $7,000, being the $10,000 you pay reduced by the 30% company tax. And so really that's fundamentally what this question is designed for you to sort of think about, that the entire point of the FBT regime is to make it so that a person on the top tax rate can't do any form of arbitrage from doing these things. But for policy reasons, the government does want to give some form of benefit for people in this situation, for something such as childcare for the employee.